Congratulations. You've decided you want to save money and invest that money and grow it over time, but you're sick of all these crazy, ridiculous crypto scams and you don't have the time to research and invest in individual stocks. Well, exchange traded funds and index funds are the perfect solution for you. They're going to help you grow your money over time, but they're going to protect you from losing a significant amount of money, which is what 99% of people investing in the stock market should be looking at, is ETFs. In this video, I have my 3 favorite ETFs that have all sold off that are the perfect candidate for long-term investors to buy in 2023 and become a millionaire. I'm going to tell you exactly what 3 these are. We've got 2 dividend ETFs and then a tech and growth ETF. So we've got a mixture of dividend payments, dividend growth, and tech, high growth type stocks. And we're going to cover from everything from their performance, their expense ratio, and then exactly what companies are in each of these ETFs. And you're going to walk away from this video ready to make your own decision about whether or not you want to become an investor in these ETFs. All right, everybody, first up, I want to tell you where I'm getting these ideas for the best ETFs, right? They are not necessarily the ETF that has performed the best over the last year or something like that. I am using strict criteria and using a very reliable, responsible source. Morningstar, they have these ETF raters where they give them analyst ratings, bronze, silver, and gold. And then I have done my research and I have pulled out my 3 favorite ETFs for investors to be buying right now. Okay, first up, our first dividend ETF, we have the Vanguard Dividend Appreciation ETF. The ticker is VIG if you want to look it up. First thing we're going to cover here is it does pay a dividend. The 12-month dividend yield is 1.96%. The expense ratio is just 0.06%. That means you are paying about $6 on every $10,000 invested. Very affordable expense ratio. They have $66 billion in assets under management. This thing has been around for more than 10 years and it's not going anywhere. Vanguard is one of the most reputable companies and a company that I would trust my own money with. Morningstar gives it a gold star rating, which is actually their highest rating. And they've broke it down into process, people, and parent. So the process, the way that this fund selects its investments, they give it above average. The people pillar, the people that are involved with this fund and making the management decisions over the companies in the fund and the allocation decisions, they get above average. And then the parent pillar, so Vanguard, gets a high average, very reputable company. They call it a solid, low-cost portfolio of high-quality dividend growers. Vanguard Dividend Appreciation ETF takes a quality approach to equity income instead of chasing riskier high yields. So what that means is they are looking at dividend income, but they also have factors that they look at like quality of company, quality of cash flows, and then dividend growth, not just chasing higher dividend paying stocks because those can be very risky. They look for overall quality in the dividend investments. Its profitable and established constituents should better insulate the portfolio from volatility. All right, and let's look at this performance and these returns. So what this is showing right here is the growth of $10,000. If you would have invested $10,000 into this fund back in 2013, it would be worth $31,932 today. And you can see it had great years from 2013, pretty much all the way through 2021. You had a down 2% year and then another down 2% year. That was 2015 and 18. But other than that, it was up really strong. And then in 2022, when the S&P 500 was down something like 18%, this was only down 9.81%. And then it's up 2.55% year to date. So a very strong performer, and it has been more safe, more conservative than just owning something like the S&P 500. And remember, this is to balance out the portfolio with this growth ETF that we're going to have. And so if we looked out on average over the last 5 years, it has averaged a 10% return. Over the last 10 years, it's averaged 11.8% per year. And then over the last 15 years, 9.88%. Okay, Morningstar gives it a low risk rating versus the category and then an above average return versus the category it compares it against. And the maximum drawdown that it is tracking is a 20% drawdown from January 1st, 2022 to September 30th, 2022. So started the year off down 20%, but then it actually recovered pretty strong from October of 2022 to the end of the year, because you saw it only ended the year down 9% or whatever. All right, and finally, let's get to the portfolio. You can see this blue circle right here. It is a large cap blend fund, meaning it's got a little balance of value and a little balance of growth. And you can see the price to earnings ratio of all the companies combined on average in this fund is 17.79%, which is about even with what the S&P 500 generally is over time. Dividend yield is currently showing at 2.12%, and then long-term earnings growth is expected to be 10%, with sales growth of 10% as well. So over here, they've called out that they are in some cyclical industries, which means that as economic cycles go, these industries can have ups and downs. They've got about 8% in consumer cyclical and then about 20% in financial services right now. In sensitive economic industries, they have 15% in industrials and 15% in technology. And then in defensive, they've got 14% in consumer defensive and 16% in healthcare companies. Those are considered defensive to economic cycles. All in all, they have 289 holdings in this ETF, and 30% of the holdings are in the top 10. And let's talk about those top 10 companies right now. You have United Health, Johnson & Johnson, Microsoft, JP Morgan, Procter & Gamble, Visa, the Home Depot, MasterCard, Pepsi, and Coca-Cola. All right, jumping over to number 2, we're gonna speed it up just a little bit because I kind of explained all the categories, so I'm gonna move through this a little bit quicker. The next dividend fund we have, Schwab US Dividend Equity ETF, SCHD. I've made videos on this one in the past. You know I love it, but I have to keep calling it out because it is just so solid. The 12-month yield, 3.39%. Expense ratio is 0.06%. Again, very, very low. $46 billion in assets under management, and it's run by Schwab, right? Not going anywhere. They get a silver rating, above average in the process, above average in the people, and above average in the parent, right? They focus on dividends and fundamentals. The Schwab US Dividend Equity ETF crafts a modified market cap weighted portfolio of disciplined dividend stocks with sound fundamentals. It applies constraints and buffers that diversify risk and curb turnover. So that means less selling of stocks. They try not to have that much turnover in the fund. So one of the things I love about this is they're looking for dividends, companies that have paid dividends for at least 10 consecutive years and boast financial health to continue the streak. All right, taking a look at this performance again, $10,000 back in 2013, worth $36,000, almost $37,000 today. It was only down 3% in 2022, and it was up 29% in 2021, which is insane. 10-year on average is up 13.47% per year. And then over the last 5 years on average, it's been up 11.22% per year. Okay, risk. Again, we're getting a below average risk rating versus category and high return versus the category. The maximum drawdown was 21% from January 2020 to March 2020. And let's jump over to the portfolio. You'll see, and I chose this intentionally, this one is more large cap value, whereas the last one, VIG, we just looked at, is that large cap blend. And so what you're gonna see, if you remember, the price to earnings ratio on average in VIG was about 17. This is lower than that by about 20%. This is at 13, right? So the dividend yield is 3.7%. And the long-term expected earnings growth rate is about 8.62% with sales growth of 7.6%. So still growing nicely and an even cheaper multiple than VIG. And you'll see these industries are kind of similar. Got 21% in financial services. You have 5% in communication services, 5% in energy, 16% in industrials, 16% in tech, 13% in consumer defensive, and 11% in healthcare. And then jumping into the top 10, a couple of these are the same as VIG, and that's okay. We've got Broadcom, Verizon, Home Depot, Texas Instruments, Merck, Cisco Systems, IBM, BlackRock, Coca-Cola, and Pepsi. All right, the one you've been waiting for. We need our 1/3 tech growth to get some of that high growth along with these dividend companies. If we are younger investors further away from retirement, we want some growth stocks in our portfolio, right? But it's really hard to pick those on our own sometimes. That's where this ETF is fantastic. And it is heavily weighted in a couple of these stocks, which is why I have it as 1/3 of the portfolio. And again, most of the portfolio concentrated in those more conservative dividend growth type stocks. But it is the Vanguard Information Technology ETF, VGT. They get a high process pillar an above average people pillar, and then a high parent pillar. Okay, so this portfolio is overweight in technology and financial services relative to the average peer in its category by 13% in technology and 2% overweight in financial services, so very heavily weighted in technology. The sector with low exposure compared to their category peers are communication services and consumer cyclical. So less exposure to communication services and consumer cyclical than some of its peer funds. Now, something to pay attention to, 58% of this fund is in its top 10s, which on average, its category peers are at 48%. So this one is more concentrated than some of the other tech ETFs out there. And let's cover this real quick. It does have a 12-month yield of 0.91% and a 0.1 expense ratio. So a little bit higher than those others, but still very, very reasonable. Performance, and you'll see this one is down by far the most in 2022, down 29%, but still since 2013, a $10,000 investment has turned into $54,500, even though it's down 29% in 2022. And it's already off to a good start this year, up almost 6%. Now, this is where these longer term returns are just kind of mind blowing. 3 years on average, up 10% per year. 5 years, up 15% per year. 10 years, up 18% per year. And 15 years, up 14% per year. At the end, I'm going to show you a calculation of like what this compound growth looks like over time and why I'm confident that these 3 funds will make somebody a millionaire. All right, we've covered it, but this one is riskier. It's more volatile than these other dividend funds that I've covered. That's why we've got the smaller allocation, the 1/3 allocation to it. Average risk versus the category, and then above average return versus the category. But it's got a minus 32% maximum drawdown, which happened from January 2022 to September 30th, 2022. So bigger drawdown than the other 2 dividend funds. Just want to point that out. Let's get into the portfolio. We have now moved over into the large cap growth category. Okay, so that's where this is coming from. And then this is 89% technology, right? So we're getting all the technology exposure we could want right here. Now, price to earnings is 20. It's actually not that much higher than VIG if you think about it on average, 20.28. But your long-term earnings growth is 11.6%, and then your sales growth is 12.93%. So you're getting higher expected growth from the companies in this ETF. It owns 368 companies. 59% of the assets are in the top 10 holdings. And then here are the big ones, Apple and Microsoft. You have 20% in Apple and 18% in Microsoft. Then you get Nvidia, Visa, MasterCard, Broadcom, Cisco Systems, Accenture, Adobe, and Texas Instruments. All right, and this is why I am confident if you invest in these funds or just high quality ETFs and stocks in general, and you invest for long enough and you invest enough money, it is inevitable that you will become a millionaire. That is the habit I want to spread to everybody. Invest as much as you reasonably can, increase that over time, and hold on to them long enough, right? A $500 initial investment with a $500 monthly contribution for 30 years. That's the calculation we're doing. In 30 years, at a 10% annual return, you will make $995,000. That's how much your portfolio would be worth. And again, remember, each of these was actually higher than 10%. They had up to 15% on average over the last 10 or 15 years. So we're being a little conservative with 10%. But I also want to bring it down and show you what 8% looks like, right? 8% over 30 years at $500 a month looks like $684,000. Still amazing, life-changing returns. And then 12%, if you do a little bit better, $1.4 million. What I want to show you, the most important thing is not your annual return, right? We're going to leave it at 8 and 10%, but we're going to go for 20 years instead of 30 years. So by just investing for 10 less years, by waiting 10 years, you have cut your investment return, your portfolio value, almost by 2/3. Just by waiting 10 years, you have pretty much 60% less value in your portfolio. So if there's anything you walk away with, invest in high quality funds, ETFs, invest more over time, and start as soon as possible. If you have made it to this point in the video, thank you so much for watching. I appreciate you. I am excited for you on your investment journey, and I would love it and appreciate it if you would like the video and subscribe to the channel. That just helps the channel grow, and it is the only way I ask you to support me. Thank you.